Hello and welcome to yet another episode of Insights with Artham FinoMetry. In this video series, we try to connect with experts and try to bring their views to all of you. Today, we are delighted to have Mr. Vishal Biraia. Thank you, Vishal Bhai, for joining us. Vishal Bhai is Senior Fund Manager and Vice President at Bandhan Asset Management Company Limited. Vishal Bhai manages Bandhan Infrastructure Fund, and he will also be managing ongoing NFO, which is of Bandhan Business Cycle Fund. Once again, Vishal Bhai, thank you for taking your time out for our investors. Let me begin this by addressing the elephant in the room.
Please.
So to give you the context, most of Artham FinoMetry's investors are very bullish on India and the Indian economy as well as market from the long-term viewpoint.
Sure.
But what worries them today is what is going to happen to market in, let's say, next 6 to 12 months viewpoint.
Right.
Specifically when markets are at all-time high, valuations are a bit stretched, there is a big US election coming up, and probably US may decrease the rates, but we do not know with what pace and what time. There are multiple geopolitical tensions happening. So amidst all this chaos, what do you think market will behave like in, let's say, next 6 to 12 months point of view?
In the midst of all this chaos, as you rightly referred to it, something that provides clarity to thought is what happens to earnings. Because in the medium to long term, it is the earnings and the fundamentals of the market that will drive the levels.
Right.
When Nifty touched 20,000 for the first time, there were a lot of concerns that markets have become overvalued. There are a lot of sectors that seem to be at that point in time way ahead of fundamentals. A lot of stocks, similarly the way we are seeing now, similarly that was the perspective that a lot of stocks are way ahead of fundamentals. Right? So today we have some more of the stocks which are ahead of fundamentals, but there are plenty of others where earnings have caught up. Or there is a huge expectation that earnings will catch up. So such stocks will more or less sustain. Right? It is the ones when the tide rolls back, that is the question. Which are those stocks and which are the ones where you will see a lot of pain? So there could be some, and that is where the concern is. But if you look at it, look at the markets in aggregate, right? If you look at Nifty and if you look at in terms of earnings, then it doesn't seem to be completely out of pace, maybe slightly overvalued. Nifty should be able to deliver a EPS of at least 1250 rupees in next financial year. Right? And if you give a 20x multiple, you come to 25k.
Right.
So March 25 it should be there. So I'm not trying to give you a target, right? This is just a framework to think, right? An investment strategy. It's like, so you are 6 months early over there. So you are like, maybe it's marginally overvalued, at least at the Nifty level. And if you look at small caps, right, a lot of people say small and mid. So if you see small cap, ideally below 250 is all small. Okay. Today the 1,000th company on NSE has a market cap of somewhere close to 2,200 crores. Right. So theoretically the universe is very big. Right. We don't go down that much in terms of selecting the ideas, but maybe at some point in time we could. Right. There could be a few ideas from that level as well. Mid-cap is one category which has been artificially constrained to only 150 stocks. And it's a large category, there are substantial flows coming in. So that is one area where we are seeing a lot of, maybe prices go
ahead of
earnings. Exactly. So that could be one segment. Then there is the SME segment, which is in its own zone, in its own orbit. So we'll skip that, but except that there are pockets of overvaluation that we need to manage as fund managers, as analysts, every point in time. Right? So tomorrow, I'm not saying, but tomorrow if the market declines, even at that point in time, the question will be, what are the stocks that are overvalued, what are the sectors that are overvalued, and what should we buy in the fund, what is more suitable. So that's a constant struggle. It was the struggle at 15k, it's a struggle at 20k, and the struggle at 25k.
It will remain like that.
It will remain like that, sir.
True.
And the way you touched on the global factors, see, what is happening is, if you look at the elections in US, will that have a bearing? Yes. but what could be the potential impact of that on earnings, right, may not be very significant. If US has a mild recession and not a severe recession, then India should be more or less fine. Right. So
flows may get impacted, but
there could be
FII flows.
There could be some impact temporarily, but even this year, if you see for the calendar year, there is FIs have sold in the secondary market, but have bought substantially more in the primary markets.
Right.
So even in this time, they have been net buyers. When we are talking about more higher valuations and lot of concerns, so even then they have been net buyers. To that extent, I think should be okay.
So as a fund manager, would you say that your sole focus, or rather predominant focus, is on earning these days, which are overvalued in terms of earnings, or which has the potential to deliver, let's say 18-20% earnings, stock specific and sector specific, rather than the macro?
So Mumukshu, see, this is the core tenet. These are the bases on which we form our view, and this is what drives. But this is overlaid with the near-term scenarios, like maybe politics, maybe geopolitics, maybe some specific natural phenomena, or some particular event in the market itself. So the foundation, the base would always be in terms of looking at the fundamentals, the various aspects of fundamentals as to what all is panning out and how is it panning out, and we overlay this with the other factors that are temporarily or may impact in the medium term, and how then we think should be positioned the funds.
Got it. Interesting, very interesting. So if I may have to add to this baby elephant into this,
please.
The major elephant we have taken care of. Baby elephant is this mid and small cap space.
Right.
Especially in last 6 months, there is a lot of things which have been written in the media, which I am sure most of our investors have also read, that it is overvalued, this and that. I'm not talking about the SME segment, that's a different saga. Right. I'm talking about the mid and small cap segment. Right. And what I want to ask you particularly in that is that most of Artham FinoMetry's investors are invested into mid and small cap funds as a category. We all know that fund managers try their best to gauge the market in terms of the earnings and everything, and they try to build a portfolio which is a little bit robust than the individual stock picking and all that. Right. So what would you say to investors of mid and small cap as a categories, the funds, whichever fund they could have invested? Do you think that this is a good time to hold or add or stagger the investments, or which way they should navigate this entire media noise as well as their own personal portfolio?
Indeed.
I understand that this is more of an advisor's role to do it, but still I am just asking.
No, absolutely. This is a very important question, Mumukshu. I think a lot of people are today struggling with what should be done with these two categories, right? So we are clearly of the opinion that small is something that we still like.
Okay.
Right.
Small cap as a
category we continue to like, and even if you look at our recommendations 6 months back, 3 months back, or even a year back, right, we have been advocating that you should be investing in small caps.
Okay.
So we have always said that the universe has expanded for small cap, the universe within which I can choose. So because of this expansion, the breadth, expansion of the breadth, I think there are enough value left in the small caps to choose from.
True. One interesting what he mentioned was that in previous question actually, that the 1000th rank companies also offer 2200 crore market capitalization. So that is something which is, I think, you as an investor and we all have to keep in mind, that when we say small cap, it is not some 100 crore cap company or something. It is 1000th rank. Most of the small cap funds, I would presume, and what we have read and what we have seen is basically they go to till 250 in terms of market capital ranking till 750. That's where the majority of the portfolio is. So fantastic. I mean, it gives us a lot of confidence actually to remain in the mid and small cap stage. So would you think that, let's say if somebody has already done an asset allocation, and let's say an investor and we mutually come at a conclusion that let's put 100 rupees in an equity funds.
Sure.
Do you think that lump sum is a way to go these days, or STP, a staggered way of SIP, is a better kind of a mode of investing. What's your take on that?
Right. Say this would, in addition to the market cycle that we are in, this would also depend on the financial wherewithal of the investor as to what is the risk appetite that he's able to manage. So what I would suggest is, say, in evergreen funds, if somebody has got a huge inflow, say a bonus or something of the sort, or some asset sale has, so they can look for evergreen funds like a business cycle fund. They could go in for lump sums as well, because the risk management will be on the fund manager's responsibility,
of course,
and to some extent asset allocation as well. So with the fund manager taking this responsibility, you should go in for lump sum and asset allocation as well. Looking at specific sectors, funds, or sectors or thematics, that is a time when you could look at something like a STP,
staggered way of
investing, where you could feel that there might be volatility in the near term, right? And let me capture that volatility. But you can't, since you can't time it, nobody would know exactly when that would happen, the event would pan out. So it's better to have some staggered STPs there. And SIP, I think, again, is an evergreen thing, which should be for sector agnostic funds like diversified funds like business cycle and all. It should be a continuous process.
Agreed. Very well said. I mean, see, if we look at it from that point of view, if we have those flexi cap funds, multi cap funds, business cycle funds, we are going to talk about business cycle fund in a bit, but those are the funds which are evergreen funds. Those are core part of our portfolio, which we might have discussed so many times. So that core portfolio can be invested lump sum without worrying about the market timing and all that. But if you are going to take any sector bet via fund in terms of infrastructure or something, that is where you have to be careful and play the timing in the market, right? So thank you for that explanation. That brings me directly to the question of your ongoing NFO, which I think started from yesterday. That is Bandhan Business Cycle Fund. Now this is a new category. Many of our investors have heard about it. Some of them have invested in it as a category, but I would still like you to give your insights that why this business cycle category excites you as a fund manager compared to, let's say, flexi cap, multi cap, or a sector fund, and how it is different in terms of managing style and how it can enhance investors' experience.
Absolutely.
So please on that a little bit.
Sure. So if you see a business cycle fund, right, as the name suggests, we want to analyze as to where is the business placed currently, and where is the sector in terms of the overall macro cycle. Each sector will have its own cycle, so where is it placed at that, and then determine, are there some meaningful investment opportunities. So there would be some medium term calls over here. So to determine as to this particular sector for these macro drivers will do very well for the next few years, right? If I have to give you an example, right? If you look at the central government's capital expenditure, it was 2 lakh crores in 2010, 4.5 lakh crores in 2021. But 2025, this financial year, it's 11 lakh crores. Right? And we think even if this grows at just about 13.5%, in the next 5 to 6 years, it will double.
24, right?
22 lakh crores. So this is doubling. So we've taken 76 years to come to 11 lakh crores out. And we'll, in the next 5 years, you will almost double it.
Right.
So we are saying that this is a meaningful opportunity. Now, once we've decided, okay, this is a sector that we want to be overweight on, then we will drill down to the specific stocks and we will build the particular weight that we want to. So in a business cycle fund, we want to be meaningfully overweight the sectors that we like and meaningfully underweight the sectors that we don't like. But even in the ones that we don't like, there could be some bottom-up ideas, right? The breadth of the market has expanded meaningfully. So say for an example, cement. Right? Even if I'm slightly underweight on cement, there could be a bottom-up idea there, right? Say in chemicals. So materials would comprise of mainly metals, cement and chemicals. I'm negative on all three. But there could be some bottom-up ideas over here which could pan in. So this makes the fund diversified, number one. And the sector deviation as compared to the index rate would be very meaningful.
Meaningful.
So for an example, if the industrials is 12% in the index of NSE 500 index, the weight in my fund could be close to 20%.
Okay.
Yeah.
Which may not happen in flexi-cap fund.
No, it will
or
not
multi-cap.
happen.
Right.
So because those people, those fund managers have promised you that they will run a diversified mandate. They have never said that we are going to play sector cycles. Whereas we are assuring that we will play sector cycles.
So will it be safe to say that flexi-cap, multi-cap as a broader category, they are more like a benchmark hugging with little bit of deviations, not completely benchmark hugging for sure, but business cycle will be more deviating from the benchmark and trying to take a meaningful bet on a sector. So it becomes a little bit aggressive to say?
Absolutely.
Okay.
So the sector deviations in business cycle fund would be meaningful, whereas in flexi and relatively may not be as much.
Okay. So that brings me to the last question of this series, that sectors we have been talking about and business cycle. When the name itself suggests the cycles of the business, it is paramount for a fund manager to identify good sectors at a good time, and at the same time to stay away from the sectors which fund manager might feel that they may create negative alpha, right? So which are the sectors that you like, let's say from a 2 to 3 years point of view or 5 years point of view as of now, and which are the sectors which you may want to avoid at this time from a year or 2 or 3 point of view, whichever way you want to put it.
Sure.
Right.
So if I have to deploy today, the things that I like today are more of utilities, electric utilities and industrials, something that I think the story is here to stay. We are seeing some macro tailwinds for these sectors to do very well, and these are long cycle sectors.
Right.
When the story is bad, it's bad for a long period of time, and when the story is good, it should
Generally
be good
longer
for a little longer, because you can't add capacity in a short span of time, right? It takes a period to add capacity. So I think this cycle should continue for some time. I also like consumer discretionary as a space, right? Discretionary consumption in India should see a pickup. I think we are going to see a scenario where disposable incomes can improve, and higher disposable incomes should drive disposable discretionary consumption.
Of course.
And we are also bullish on certain non-banking financials, where we think that the impending rate cut cycle, starting with the US and consequently in India as well, should help these stocks.
Okay.
So these are some of the ideas that we like very meaningful.
And which sectors you may probably avoid for, let's say, short term?
Yeah, so I would be underweight on, I don't like materials at this stage, be it metals, chemicals or cement. Would also be underweight on energy.
Okay.
To some extent. This is not electric utilities, mainly oil and gas.
Of course.
And also on staples to some extent. Right? So we are actually very focused in terms of business cycle fund, where you're saying that we like consumption but more of discretionary and less of staples.
Right.
So as an investor, you get to actually capitalize on all these movements as well.
True. Fantastic. Thank you so much. And viewers, it is very important to know that when we talk about markets and economy, we have all the rights to go wrong. So these are as of today. The views are as of today. It may change tomorrow, but that is how the professional management and the fund management and the research analyst team, they try to bring a value addition to your investments. So Vishal Bhai, thank you so much for joining us.
Lovely meeting you.
Thank you so much, and thank you viewers for watching. Stay tuned for the next episodes. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.